Geoff Lewis. Geoff is Head of Investment Services at JPMorgan Asset Management. What are you making of it all, Geoff?
Well, we had the Fed reasonably upbeat, revising up its growth forecast for this year a little bit yesterday, and Bernanke confirming that if, say, the labour market does stall, if we do see a succession of poor jobs numbers, you couldn't rule out further QE and further easing. So I think that was one factor. Plus, of course, I think we're getting a realisation that the U.S. recovery is starting to broaden out.
We'll see more of that, won't we, when we get the GDP number?
That is correct. We're certainly looking for a number within, say, 2.5% to 3% for this quarter. And that should be taken quite positively by the market, because I think expectations have really sort of maybe swung a bit too far away from steady U.S. recovery over the last month or so, when we've had some negative economic surprises on balance.
There's a conspiracy theorist inside me as well, which is wondering why we keep on leaving the door open to, let's say, quantitative easing. And is it perhaps to keep the dollar low?
I don't think that's the Fed's objective, no.
It does help the economy rather a lot, doesn't it?
It can help. It's pretty much a zero-sum game, though, if all the major central banks engage in monetary easing, hoping to have a race to the bottom with their currency.
Well, everybody says that that's what they're doing.
I think that's a little unfair. The Fed's focused primarily on domestic economic conditions. The U.S. is still a huge continental-sized economy, and really to target the dollar would be to let the tail wag the dog. So I think they're more concerned with the domestic economy. We're seeing signs that housing has bottomed and is no longer a negative contributor to growth. Possibly the local governments will be less contractionary going forward. And consumer sentiment seems better than it was at this time last year.
So it's for real. That's what the numbers should bear out.
We think that the U.S. economy is going to outperform relative to the other regions, particularly relative to the Eurozone.
Geoff, talk me through your regime work. I've got this in the notes you sent to me. What does that mean exactly? What is your regime work?
Well, basically, it used to be known as the investment clock. It's like a circular diagram. You divide it up into quadrants where you have initially activity and inflation coming down, and then you move into the reflation area where activity starts to pick up, inflation is still low. Late in the cycle, you might have some inflation pressures coming on, and that's typically when monetary authorities will start to tighten. So it's a schematic way, but it is quite helpful, I think.
So you're saying it's entered a very distinct period now?
Well, we think we're in the situation now where the U.S. is into this broader, more sustainable recovery. And also there are signs that the Asian economies are now picking up after the weakness that we saw in the fourth quarter of last year.
Let's also just talk about that as well. So if Asia picks up, of course, that's got to be good news for the U.S. and vice versa, naturally, here as well. So does it mean that we can now rule out further liquidity and further stimulus?
Well, I'd like to think that would be the case, because...
Especially as it's election year, it wouldn't really be that popular if we keep on having to have stimulus to maintain growth.
Well, of course, I think it's the fiscal monetary policy mix as much as anything. So we need continuation of loose monetary policy whilst we're still requiring fiscal contraction. And that's the big uncertainty for the U.S. How much fiscal contraction will there be? What will the next administration do? And at the moment, of course, there would be a big fiscal contraction if there was no agreement in Congress. So I think Bernanke probably is keeping his powder dry. I think he will step in if he thinks there's going to be too much fiscal tightening next year. So that is an important aspect of this debate, I think.
Now, we were talking about the U.S. Let's talk about another leg of the world economy, and it's that pesky one, which is Europe, which is giving us all sorts of trouble at the moment. And May the 6th looking like, well, a red letter day to say the same.
That's right. We've got the French election then, and
Greek voters
as well. Greece, we thought, was out of the way, but possibly it's a problem that could yet come back to haunt us, because even with the restructuring, the IMF is forecasting that Greece's debt GDP ratio will be a little higher at the end of this year than at the end of last year.
Because the Bank of Greece just the other day downgraded the growth forecast, should I say, downgraded the contraction forecast, we should say, to 5%. I mean, that's another 5% shrinkage of that economy, which, of course, then hits that debt-to-GDP ratio you're talking about.
That's right. The Greece economy has already contracted by 15% of GDP, possibly another 10% over this year and next. So you're talking about a 25% fall in Greek GDP. And this is really what's leading to this realization that maybe austerity alone is not enough. We're seeing signs of austerity exhaustion, even in countries like the Netherlands.
Absolutely, and of course the government fell there the other day. But let's talk a little bit about France. So the two sides seem to be fairly close. They do, I think it's François Hollande, the socialist, who's saying that there should be a plan for growth, though, and that should be really built into this fiscal pact we're talking about.
Well, that's right. I think Monsieur Hollande's administration would be responsible. I don't think it would be like full-blooded socialism. When the Mitterrand government came in, the French stock market fell 30% in the next month or so. That was a different era. And to be honest, I think that the realization that there needs to be a growth narrative in Europe is something which even Mr. Draghi, head of the ECB, is now saying in public. The IMF have been saying it for some time. And to me, it makes a lot of sense. These fiscal targets were chosen in 2009 before the Eurozone debt crisis had really begun to materialize. So it was a recovery path after the global financial crisis. It would be very sensible, I think, to reconsider those objectives and maybe achieve fiscal consolidation over a slightly expanded timescale. I think markets and investors would accept that as being a sensible compromise.
Well, in the midst of it all is one country which does very well, which is Germany, and they're loath to really be adding more cash into the pile that the European Central Bank wants.
That's right. The Germans are proving to be the stumbling block. They're the ones that are insisting on austerity. They are seen as the paymasters for the bailouts, and their advice seems to be to other countries to become more competitive, to become more Germanic. But not every country can rely on net exports for its sources of growth.
Okay, let's talk a little bit about valuations out there and what you recommend to people. I mean, I'm assuming that you're perhaps underweight when it comes to European equities?
Yes, within our global equity portfolios now, we are underweight Europe, underweight the UK. We are overweight the US. And on a tactical basis, we've been overweight Japan. Emerging markets, we also see good opportunities there, obviously.
So where are we with the world economic cycle then? The US recovering, Asia, well, pretty much reliant on what happens elsewhere, but it's China which is proving more and more to be the growth driver here.
China remains an important growth driver, not just for Asia, but the spillover analysis by the IMF shows that China now affects economic growth in every corner of the world. So it is important we do have a soft landing. I think the signs are activities picking up a little bit going into the second quarter.
There's no landing, really.
That's right. It's a very simple analogy. Economies do take off, as Walt Rostow reminded us, like Britain in the 19th century with the Industrial Revolution. Once up in the air, they tend to stay airborne unless they crash.
Exactly. So there's either a hard landing or nothing else is what you're suggesting at the moment.
Well,
where are you? I mean, equities have not done well in China. So, I mean, do you position yourself there at the moment as well? Because we've seen a three-week rally.
Valuations are very, very supportive. They're back to the 2008, early 2009 levels for many sectors of the Chinese equity market. Of course, it is a very policy-driven market, and I think investors are looking for signs that the economy is bottoming out or that there will be some significant monetary policy easing. So that's the catalyst that everybody is waiting for.
And what is this fiscal cliff that we're talking about that the US faces?
Well, the fiscal cliff is that on present plans, if there's no agreement between the administration and Congress, then the US will see fiscal tightening next year of 3.5% of GDP. That is far, far more than there has ever been in any previous period of fiscal consolidation. More than a healthy economy could stand, and certainly far more than the US economy is likely to be able to stand in 2013.
Pretty concerning, Geoff, for next year, after elections are out of the way. Whoever is the president, I imagine Obama, inherits or picks up or takes forward a pretty bad economy, a lot of debt, the fiscal cliff, and of course Europe is not out of the woods at all. So next year could be pretty bleak.
Well, we could have this...
the optimist, John.
Yeah. We could have these worries surfacing, I think, towards the end of this year. Although, actually, we believe the U.S. economy has made a lot of progress recently and is on track for a more sustainable recovery. Yet there are all these fiscal worries. Now, you could argue that at the end of the day, Congress will do the right thing. They'll be sensible. If it's really going to kill the economy, it will never happen. But the uncertainty itself actually has some negative impact on jobs output. That's pretty clear from the work of Professor Nick Bloom. He's done a lot of work on this, and macro uncertainty can damage those animal spirits. Now, at the moment, the animal spirits are getting better in the U.S., but they're still fairly fragile.
My favorite word today is bifurcation,
yes,
which is
bifurcation.
what Lloyd Blankfein was saying, because, yeah, take a look at the economy and the economic signs you're getting in the U.S. It doesn't match the corporate earnings and the numbers being put in by Apple, by any number of corporates that continue to beat the street.
That's right. The corporate sector has done very well.
What the economy is saying and what the market is telling you right now.
Well, I think the markets are telling us that U.S. companies have done a good job keeping their costs in order. We had very strong productivity growth, although it's been less strong over the last quarter or so. That is a key, I think. If productivity performance continues to tail off, we'll see rising unit labor costs and probably profit margins coming down. We'll see the peak taken off those profits. That would be a negative. But I think you're right. Corporate profits are continuing to surprise on the upside, even though the economy is only growing at a moderate rate.
Right.
You talk about uncertainty in the U.S., and I'm sure with respect to this fiscal cliff that we were talking about, the Congress is going to take it to the last minute because the White House and the Congress will not be able to agree. So investors almost certainly face uncertainty as we near the end of the year. Is that your view? Or I
think there's a strong risk that we'll see something of a repeat of what happened last summer when there was all the uncertainty over the debt ceiling and over whether there would be a sensible agreement on fiscal consolidation. And that is worrying, although the statistical evidence is that these uncertainty bouts, they might have a negative impact on the U.S. economy, on jobs, but it's fairly short-lasting. And it was not enough to derail growth. It could have contributed to the weak patch towards the end of last year, but it didn't actually cause a reversal and an inflection point. So I would say, yes, there is a cost to Congress posturing. There's a cost to the theatrics, but it's not as bad as a real economy shock.
So as we head towards the middle of this year, how are you reallocating, if at all, your assets?
Particularly when it comes to Asia as well.
That's a good question. So far, we've been relatively content with the kind of portfolio planning we implemented at the start of the year, which was to diversify, to look to some of the credit markets, to be underweight sovereign bonds in the developed economies, but to be overweight emerging market debt, to have some high yield credit, investment grade U.S. credit, some exposure to REITs and property, to be very well diversified, to be a little bit underweight equities, but not too much.
Isn't that against consensus? I mean, more people have a bias towards equities because you're not making much in terms of yields and fixed income.
Well, that is where we think our approach has paid off, because the yields are very low if you're looking at, say, U.S. Treasuries or bonds. If you're looking at sovereign debt, you can still achieve a decent yield. Our global multi-income fund, for example, has a yield of around 5%, 5.5%. So it is possible not to have to stretch for yield and look for it in really high-risk places.
You could get 10% if you were in the U.S. markets this year.
We are overweight in certain areas of the U.S. market,
right.
And in equities, we particularly like good quality, high-yielding stocks with reasonable growth prospects. If you just go for yield alone, it's not a good signal. But it is...
the high yields tend to mean, of course, that the stock's been beaten down or something or the other, and they've remained, their dividend policies unchanged. But what about Apple? Just want to talk, last question about Apple. $110 billion of cash. Those are their cash reserves, apparently. I've been told that that is enough to fill 50, and then 50 Olympic-sized swimming pools.
That's amazing, yes, yes.
In U.S. dollars?
Depends on what
Is that
notes.
right?
Well, I'm assuming that they're going to be in with dollar bills. That's what I've been
bills
told.
must be.
That's what I've been told. I said that. Yeah, well, exactly. I don't know. Maybe with Hong Kong dollar bills, but no, it's definitely U.S. dollar bills. Well, that's great. Geoff, thanks very much indeed for that. Geoff Lewis from JPMorgan Asset Management.